Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing Accenture stock, ticker ACN. This one came in by request down in the comments section of one of my other videos. If you have a request you'd like me to take a look at, just put it down in the comments. I'll get the ticker up on the whiteboard behind me, and eventually I'll make a video. If it's a stock that's in the S&P 500 like Accenture is, I post those on YouTube for free, and the rest that are not in the S&P 500 I post over on Patreon at the $5 tier a month level. There's also a free tier over on Patreon where I post all these YouTube videos. So if you don't want to depend on the YouTube algorithm to get my work out there in front of you, or you want to go search it. And then I also occasionally will post things that I don't post on YouTube on the free tier over there. Those links will be down in the description, along with a 25% off affiliate link for Fast Graphs if you want to give Fast Graphs a try. They have free trials over there. And I'm going to be using it quite a bit in this video. As always, this is not individual investing advice. It's just how I analyze stocks. So I'm happy to see Accenture come up because I've had a lot of stocks that are kind of difficult to analyze lately, which makes sense that those would be the ones that people have the most questions about. But when we look at the historical earnings pattern of Accenture, basically they just rise every single year. If we go back maybe to the Great Recession, they had kind of, let's look at it real quick. They had like two flat years, basically up 1% in 2009, down 1% in 2010. But for the most part, they haven't been particularly cyclical. They've just been kind of like a secular growth business. And pretty much the past 20 years, earnings have just gone one direction. That usually means the stock price has generally gone one direction too, and they've been a fantastic investment. If we look at one of the things we can do on Fast Graph is we can just go back to 20 years ago and then see what the CAGR has been. It's been 14.38%, including the dividend there. So fantastic returns. You could have bought and held this one and done really well with it. Now, one of the concerns that a person could see just by looking at the Fast Graph is that the current PE is almost 30. It's like 29.28 using a blended PE ratio. I'm actually going to use forward earning like for next year when I do my calculations here, just to be more generous. Because they're kind of rounding. I don't know if they reported. They still have the estimate for earnings, the E next to the estimate number for earnings to wrap up their fiscal year which ends in August, it looks like. So I don't know if they've reported that one yet. But if they haven't, they're close to doing it. So I'm going to go ahead and look forward 1 year to be more generous with my valuation. But I mean, you can look. They've had pretty steady earnings growth as we've seen. But they haven't traded at, if we go back in time, let me see if I can get rid of this. Hold on a second. If we go back in time to, I don't know, you could pick like any time, but we'll find something like mid-cycle, like 2014, traded at a 17 or 18 PE around that time, like mid-teens. Going back all the way to 2012, mid-teens, before the Great Recession. It peaked out about 22 PE right before the Great Recession. Before that, again, like high teens multiple for most of that time. And they were growing very fast, like 36%, 26%. Like they were growing really fast back then. And they only had a 20 PE. And when you look at the past couple years, so 2023, they grew earnings 9%. 2024, 2%. Next year is only supposed to be 7%. So earnings growth at this particular point in time is like, we'll call it high single digits. I'm going to use like a 10%, 10 point something in my estimate when we get there for future earnings growth. But really the current earnings growth is very slow, especially when you consider we've had like 3% inflation or something during that time. And then when you compare that to what is basically like almost a 30 PE, the stock is pretty expensive here just when you just look at it on the surface. Now I will say that they do have like net cash almost, it looks like. So that should probably be taken into account. I don't know if I actually set my spreadsheet up to do that in this particular case, but you can just, well, let me go. I'll go look at it to find out. I should have double checked it before I came, or before I set this up, but let's see. Yeah, so I have just a slight benefit coming from, so their total enterprise value is actually less than their market cap. So that tells you that they probably have some cash on the books. And I'm going to say this looks like about 22, maybe like 10 to 12% or so, just off the top of my head. I don't have my calculator handy. So I'll go ahead and adjust that just roughly based on that. So right now I had it, last time I updated that particular number, it was like a 1% difference. So we want this, let's do like 0.88. That'd be like and what that does is, I'll get to this in a minute, but so their stock price is currently about $350 a share. If we take into consideration whatever kind of net cash they have, then it's more like $308 per share. And so what that does is it lowers the real like actual PE ratio. So it's more like 27 PE instead of that higher 29 or almost 30 PE that we saw in the well, let me see actually what it was before. It should change it if I have it in right. Oh, that might not take into account. But the enterprise, earnings yield, sorry, EV earnings, that's enterprise value earnings, which is what I'm using. That should change here if I change this. So yeah, so it raises it up to a 4.2 earnings yield. That will actually be calculated into the earnings the earnings that we could collect as owners here in just a minute. So that will help out the valuation a little bit. Yeah, I see that it does. Okay. So actually, let's just go ahead and get into that valuation since I'm here. I'm going to assume they can grow earnings at 10.82%. That's roughly based on what they were able to do probably since about like 2016 or so. That's kind of what I'm going back to lately. So roughly about right in here. Fastgraphs has 10.6% earnings growth. So now we also did have corporate tax cuts that probably gave a boost, stimulus money. Those are their three highest years. If you were to pull those out, this earnings growth is probably high single digits instead of 10. So I think I'm being plenty generous here. They don't really have like super fast earnings growth, but they're definitely like consistently growing. So I think I'm being relatively generous with almost an 11% earnings growth expectation. So if we take that, we make the adjustment for their cash, we get that 4.2% earnings yield, which is the inverse of the PE ratio. So instead of putting the price over the earnings, you put their earnings, which I pulled forward, which are $12.93, over the price, the adjusted price, which would be $307. And those two things should give you a 0.042 earnings yield, or when you convert it to a percentage, 4.2% earnings yield. So the way I like to think about that is if I bought their whole business for $100 and I owned the business, I could take out $4.20 of earnings each year, and then that $4.20 of earnings would grow at 10.8% or whatever that I used over there. And that would grow each year. And what I want to know is how much money could I collect over time if we have those assumptions. And I usually pull the first year forward when I do this. So I assume it'd be $4.20 for every $100 plus 10.88, what was it? 10.82% growth, right? So the first year I would get $4.65, and the next year still have that 465 plus 465 and 10.82% growth. So that's what my spreadsheet's set up to calculate. So I like to go forward 10 years and see what my $100 theoretical investment will grow into, and it will grow into $177.15. So If you put this in a CAGR calculator, you start with $100, you end with 177. It should spit out a 10-year earnings CAGR, compound annual growth rate, of 5.88%. That's pretty similar to where the market's at. This market's kind of around like 5.5, give or take. When I before I made the adjustment for it looked like the cash that they had, this was like 5.38%, I think, 10-year CAGR. So, so they're right in that range, depending on what kind of forward-looking estimates you want to make. This is pretty much right where the market's at. So there's nothing like super difficult really about kind of understanding what the market's thinking. Market's thinking pretty much what I am, give or take, a little bit. Maybe they have a little smaller earnings growth rate, but it's right on target pretty much with the rest of the S&P 500. But you do get a high quality business that's very dependable so far, at least historically has been. But that's still not a great return. Usually if it's under 5%, that's when I would consider like trimming or selling a position. So it's not cheap, but if you have to choose between this and like a lower quality business that isn't as dependable, that has the same 10-year CAGR expectation, then you would want to take the higher quality one, I think, right? Now, in terms of buy prices, I like for this CAGR to be over like 8% for me to buy. That's with the margin of safety, and then trying to get really good returns. Right now, the stock, again, trades about 350. It would need to get down to 207 to get that CAGR up to 8%, that return. That's about 40% lower than where the stock is right now. And then if there's a recession, and there's a recession, if I go back and use the data from the 2008 recession, then it would need to fall about 45%, and the buy price on that's closer to like 194. And then, of course, like fair value would be somewhere in between there. So somewhere in between 207 and 350, probably like 270-ish, something like that, 260. Probably right in there is probably kind of like just a long-term like fair value if they can grow at 10%. So if you were just trying to pick up like a high-quality business and you weren't looking for a margin of safety or a discount and extra returns like I am down at 207, 260-ish, 270-ish is decent price to come in and buy. If you decide you like the company. So yeah, these guys do like IT consulting and other services. They're known to be very good and very high quality. Maybe the highest quality you can buy probably, or in terms of like their reputation compared to other ones. I'm generally not super bullish on these type of companies, but I would absolutely buy this one in a second if it got down to my buy price. And I don't think it's super crazy if we look. So remember, their earnings haven't really grown very much the past couple of years, and they traded down to 243 in 2002 and 2003 twice. So just a year and a half ago, we saw the stock price down below that kind of fair value range that I was talking, like that 260 range. In fact, I'd probably say that basically what it did is it traded down to fair value, and that's pretty much where it bottomed. So it just never got cheap. Now it's up a lot since then. Let's see, like if you'd go from 250, see if I can click it. Don't know if it's gonna work for me. Okay, it's not locking in right now, but yeah, 250 up to 350. So it's had a good run since then, and now it's kind of valued the way the rest of the market is. But I like buying these high quality businesses on dips rather than trying to kind of buy the lesser quality businesses, even though they're cheaper some of the time. But the market's really fond of these. They're really fond of this stock right now. I mean, most people that have bought it are up on the stock. Definitely if they bought it a long time ago, but and it's off its highs by about 50, off this little peak here by about 15%. But I doubt too many people were buying it up there. But you can see sometimes these stocks just get too expensive, right? So during this kind of bubble peak, it was at 414. People that actually bought at 400 probably are going to be underwater for 5 years, and then maybe if the business is still good, the next 5 years they'll get okay returns, right? That's why you don't want to pay too much for any stock, really. And then you could have, when you could have bought it, 40% lower just a year later, basically. All right, if you found this useful, hit the like button and the subscribe button, and I'll see everybody later. If you have a request, put it down in the comments section. I'll get it on the list, and I'll make a video for you. Later.